So we talk about the traditional monetary policy tools, right? So let's talk about more the modern monetary policy tools. So after 2007, 2008, the Fed has to come up with a new tools in order trying to expand the monetary policy in the U.S. and as well other types of which contract monetary policy as well. So there's a new tools that is available to the Fed that was just first implemented after 2007, 2008. So as you can see here, the first one we call quantitative easing. So we know that Federal Reserve buys, he buys T-bonds from banks, right? But after 2008, the Fed also started buying other types of papers. So it started buying like mortgages or other types of papers, such as other type of loans. In which, so the T-bond is the most secured paper out there in the economy, right? So it's a T-bond from the United States. However, in order to help banks, the Fed started buying like other types of papers, such as we talk about mortgages, and usually those mortgages, especially in 2008, 2007, are quite what you call toxic because they're really risky. So the Fed started buying those papers in order to help out those banks to not be bankrupted, right? However, if you think about, all right, perfect, the Fed, it's buying other types of papers from the banks, and the money, and the bank has those money right now, trying to spin the role of the economy, right? To try to put more money, people get more loans, more investments, and so forth. However, think about now how the bank is gonna pay back the Fed to buy this paper back. Do you think that the banks that just got like almost got a bailout from 2008, 2007 would have buying those papers, the toxic papers back? It's something, it's kind of hard to think, or really not easy at all trying to think about how the Fed's gonna sell those papers, because probably no one's gonna buy it. They're really toxic unless you pay a lot of like interest rate on it. So seems like the quantitative easing, it's more like a emergency type of measurement that takes place in different moments of the economy. We might see that type of policy more like extreme during around the coronavirus outbreak, right? Might not be similar what happened in 2007, 2008, but you might see some of those types of like emergency type of policy. The second one that also is kind of modern is kind of the Fed started paying interest rate on excess reserves. So imagine that the reserves, the required reserves is 10%. If the bank says more than 10%, less than 15%, they would get like interest rate on those 5%. They create from the reserve. So this kind of creates incentives for banks to be more, to be less risky and try to save, create a higher reserve, right? However, when a bank has incentives to increment their reserve, they might impact how much money they are offering through loans to the consumers and to the economy. So it might have a different impact in how to guarantee that the society has access to a lot of loans, and also to keep like flowing money from the banks to the society. So the way to do that, the Fed has to figure out a way to incentivize banks to save more than the minimum reserve, but also figure out a way that this interest rate cannot be too high to not preclude banks to offer more loans to the population. It's kind of a tough job that the Fed has to do in order to figure out what would be the interest rate to pay in the excess reserve. All right. So those would be the two types of impact my modern tools that the Fed might use in order to either expand the economy through monetary policy or to contract more money supply. So see what else here. So the pitfalls. So as the marginal revolution video was talking about, one of the main pitfalls of monetary policy is timing. So usually when the government is looking at one condition, or now let's imagine a recession or even a depression that I might see in a few months from now on because of the coronavirus. If the Fed trying to come up with some policies, those policies just come up with an effect in a really lag way. So it usually takes at least 6 months for the economy to start seeing the impact of the Fed policy. So in 6 months from now, this outbreak might be gone. I really hope so. And the situation might be different. So its timing is essential for the Fed to figure out what's the best way to approach a problem, because it's really hard to figure out how the economy will be doing in 6 months from now, especially during recessions and depressions. So it's really hard for the Fed to figure out the perfect timing. And as well as the marginal revolution video was talking about, the quality of the data also impacts a lot. Another pitfall that is kind of hard to understand or kind of hard to go around, it involves the quantitative theory of money. So let me explain this first, and then I can explain the pitfall. Sounds good? So the quantitative theory of money is an identity that tells you the money supply, M1 or M2, depends how you define, times the velocity of money. In other words, how fast or how quickly a money can circulate through the economy, right? How money is circulated through the economy across different sectors. It's equal to the nominal GDP, price times output. Okay? So this is equal to the nominal GDP. Sounds good? So money supply times velocity, it has to be equal to nominal GDP. So let's imagine now that the Fed wants to increase money supply. In other words, he wants to increase M, right? Why he wants to increase M? To guarantee that the nominal GDP also increases, right? Because remember, there's an identity. If I increase here a number, these guys here is also going to increase. Sounds good? However, this makes sense if we assume that velocity is remain constant. In other words, if you know how much is going to be the velocity of money, it makes sense. So if I want to increase nominal GDP by 10%, I just have to increase money supply by 10%. This is a really simple example, right? You don't consider the money multiplier and so forth. So let's assume that the increased money supply by 10%, this remain constant, the nominal GDP would increase by 10%, assuming you have no money multiplier, right? However, do you think it's kind of real to consider that the velocity of money is constant over time? So actually it is not. So the velocity of money changes a lot, depends on different market conditions. So it's kind of hard for the Fed knows how much increase the money supply in order to increase nominal GDP, because it's going to depend on the size or the magnitude of the velocity of money, right? So it's kind of hard to decide how much increment money supply, because you do not know how much the velocity of the money is going to be. So if you look at this graph right now, just a second, right here, tells us the velocity of assuming M1 as the money supply has changed over the years. So as you can see here, it's not stable, right? So between the 60s and the 70s, it's kind of like a straight line. So there's like a little increase. So it's kind of easy to understand. But after that, it becomes really unpredictable. So we do not know, actually the Fed doesn't know how much increase, if the Fed wants to expand through, expand the economy through expansionary monetary policies, you want to increase money supply. However, by how much should increase money supply to increment the nominal GDP? We have to figure out the velocity of the money. So it's really hard right now to understand how the velocity of the money is at this moment, or how would it be in the future. So this is kind of the pitfall that the Federal Reserve face quite constantly in order to understand how much to expand the money supply. Okay, so a question, if velocity is constant over time, then a positive change in the money supply will lead to what? A positive change in the same proportion of the nominal GDP. All right, so this is what happened, and assuming that identity. But as we talk about, we have to know how much will be the money velocity in order to make sure how much you should increase money supply to impact the nominal GDP. Sounds good? So these are a pitfall: timing, quality of the data, and also to understand the idea of money, of velocity of money. And lastly, I want to talk about further monetary policy discussion. Usually, when you're talking about monetary policy, especially for the majority of countries such as Brazil, usually the Fed, or the central bank, is concerned about inflation, not unemployment, right? However, here in the US, the Fed has to be concerned about inflation and also unemployment. So if you think about let me just open here. If you think about the economy on the long run, right? So if in the long run our aggregate supply is a vertical line, cannot forget that. Oh, this was not fun. Not good. Just a second. All right. So these would be Y. These would be price level. So our aggregate. So we're in the long run, right? If the long run aggregate supply. I then we have also a aggregate demand. So these would be price level. If the economy is concerned about inflation, what the Fed's going to do, it will be more contractionary type of policy, right? So the Fed's going to start selling T-bonds, one of those examples. What are we going to have to aggregate demand? I'm going to shift. Oh, man, this was not good. I'm going to shift to the left. So this will be 0, be 1, be 0. So when I get to the price level, we know price level is going to decrease, right? All right, so we are concerned about inflation, so the price level is going to decrease. However, looking at this graph, we might think that the Federal Reserve also should care about unemployment, right? So what is going to happen when we have a situation in which you have the aggregate demand, aggregate supply, right? So these would be the long run aggregate supply. If the aggregate demand moves to the left, what is going to happen to unemployment, at least in the short run? Most likely, we're going to increase, right? Sorry, guys, this is 0, this is 0. It's supposed to be a star. Because unemployment, you can calculate using the GDP gap. So the second moment when we're producing at a GDP 1 or output 1, the gap is much larger, so it might create a large unemployment. So this might be an impact that the Fed also has to pay attention on that, right? So in the case of the United States, the Fed should first focus to inflationary problems, should then concern about unemployment, right? And always think about the long run growth. So this is the idea. When you think about long run, the Fed can change aggregate demand to impact inflation, but by the long run, also they have an impact in the short run for unemployment. So we all should pay attention on that. Okay? So these are the things that I want to cover today, right, from this chapter. Please watch the videos from Marginal Revolution to then watch this video, because this video is more a summary what you guys are going to watch those videos later on. It's going to be easier for you guys to study. Sounds good? Hope you guys have a great week. Take care.